The dollar is surging, the euro is cutting rates, and the yen just hit levels not seen since the 90s. Three central banks, three completely different playbooks, and crypto is about to pay the price. Here is what nobody is talking about. For years, Bitcoin moved almost in lockstep with the S&P 500 and the Nasdaq. Risk on, everything pumps. Risk off, everything dumps. Simple. But in 2026, that correlation is falling apart. And the reason comes down to something most crypto traders completely ignore: central bank policy divergence. Right now, the Federal Reserve is holding rates steady, waiting on inflation data before making any move. Meanwhile, the European Central Bank has already started its next round of cuts, trying to keep the Eurozone from sliding into recession. And then there is the Bank of Japan, which is actually tightening for the first time in decades, pushing the yen into violent swings that are rippling across every global market. So what does this mean for BTC and ETH? When central banks move in the same direction, liquidity flows are predictable. Money either floods into risk assets or it pulls back. Crypto follows. But when central banks diverge like this, you get chaos. The dollar strengthens against the euro but weakens against the yen. Carry trades unwind in one direction and pile up in another. Traditional risk-on and risk-off signals break down completely. And that is exactly what we are seeing in the data right now. The 90-day rolling correlation between Bitcoin and the S&P has dropped below 0.2 for the first time since early 2021. ETH is even more disconnected, trading on its own liquidity dynamics rather than following equities. This sounds like freedom from traditional markets, but it is actually dangerous. When crypto loses its correlation anchor, it also loses the institutional bid that comes from portfolio managers treating it as a risk-on allocation. Without that bid, the floor drops out. Think about it this way. If a macro fund is long BTC as a Nasdaq proxy and the correlation breaks, what do? They sell. Not because crypto is broken, but because their model no longer justifies the position. Now layer on the currency volatility. A strengthening dollar historically crushes crypto. But if the dollar is only strong against the euro while getting hammered by the yen, the signal is mixed. And mixed signals in macro mean one thing for speculative assets: lower liquidity and wider spreads. The altcoin market is especially exposed here. Smaller tokens depend on speculative flows that dry up first when macro uncertainty spikes. If you are holding mid-cap altcoins right now, watch the dollar-yen pair as closely as you watch any chart. That is your real leading indicator. Do not ignore what the central banks are telling you. Follow this channel so you are ready before the next move hits.